My name's Andrew Lucas. I'm the Director of Capital Markets here at Tryon Properties. So I kind of head up the capital raising and investor relations. And we're here today to talk about Azure at Riverside. It's a really compelling 267 unit property in Austell, Georgia, which is a western suburb of Atlanta. And this specific location we're really excited about because it's kind of become an industrial hub of Atlanta, and it's just seen a lot of growth over the past 5 to 10 years. And I'm just going to give you a short overview, and then I'll kick it off or hand it over to Marley, Adri, and Max to discuss the details of the property. Next slide, please. So again, my name is Andrew Lucas. Max Sharkansky is our managing partner, and then Marley and Adri, who Adri is not pictured, but they oversee our Southeast acquisition. So as a lot of you know, we've historically been based in LA, but we really entered the Southeast about 2 years ago. And then last year we opened up an office in Miami that covers that region for us. And we've been around since 2005. We've done, over nearly $1.5 billion in acquisitions, and we solely focus on multifamily real estate and primarily value-add multifamily real estate. So for us to buy a deal, essentially there needs to be a compelling reason as to why we're very confident that we can drive the net operating income and ultimately drive the value of the property. And Azure fits, right into that wheelhouse. And again, we've been around nearly 2 decades. We've demonstrated the ability to be successful in good economic times and in bad economic times. And due to our kind of targeted philosophy, we've been able to achieve over 30% annualized returns for our investors on the over 40 deals that we've exited. So with that, I'll hand it over to Marley, who can give you the specifics of the deal. This webinar is being recorded, so obviously, try to pay attention, but if not, we will email out a recording. And then if you do have questions, feel free to ask them in the Q&A box, and we'll be happy to answer any of them at the conclusion. Marley?
Yeah, my name's Marley. I run the Southeast acquisitions for Tryon. So I'll go through the deal. As Andrew mentioned, this was a deal that we sourced off market. The current owner has owned it for about a year. The reason why they're selling is, frankly, they have a super promote structure where over a 15 IRR, they get a vast majority of the income. So it behooves them to sell sooner than later. So that's our opportunity to buy it off market and move quickly. It's 54 million, which is about 200 a key, 267 units, and it was actually built in 2 phases in 73 and 79. We plan to hold it for 3 years, and we'll get into exactly what that asset management plan looks like a little bit further on here. And the untrended return on cost is 5%. Excuse me. So as mentioned, it was built in 73 and 79. It's primarily 2 and 3 bedroom units. This is a more family-oriented area of Atlanta. Which is pretty interesting. It's only 15 minutes west of downtown, 15 to 20 minutes, depending on traffic. So it's really close to downtown. But this is one of the first kind of family areas that you get to where you can get the 2 and 3 bedrooms at reasonable prices. So the average square footage here is over 1,000, which is a little bit larger than what we typically look at. The amenities are there's the clubhouse has been renovated. There's a really nice pool that has just been resurfaced as well, and then there's a sports court. The micro market is part of the story here. So this Austell 10 to 15 years ago probably wasn't an area that you would find a lot of institutional investors. It was a very, very blue collar area, a little bit rough, to be honest. A lot of these properties were owned by what you would categorize as slumlords. But what's happened as the Amazons of the world and logistics has become more important is that this area has become a massive logistics area with a huge amount of warehouse. The reason being is a couple things. One is it's 12 to 15 minutes from the airport, Atlanta being the largest airport in the US. And it also sits right on Highway 20. Highway 20 is one of the main east-west corridors in the Southeast. So it's extremely well located. And at the time, the land was very cheap. So that's why so much industrial got built up. And now there's 60 million square feet of industrial starting literally right across the street from this property. And you'll see from an aerial that we'll show you in a bit here, just what that looks like. So what's happened is these kind of lower blue collar jobs have now become upper gray collar jobs with logistics paying well, and there being a large influx in this. And so much of the properties in the area, I mean, almost all of them for that matter, have been bought up by institutions over the last couple of years who are starting a renovation program to upscale the properties, and the area's become much nicer over the last 5 years or so. Atlanta at a high level is one of the better markets in the US. The population growth has been extremely high, the job growth as well, and it's expected to only continue to grow. There's a huge amount of development. Part of the reason why markets like Austell that are kind of within the first ring outside of Atlanta have done so well is because the rents in downtown have just gone through the roof. So the rents that we have here are less than half of what you would find in downtown. One of the things to mention here, and this is getting into our value add strategy. As I mentioned, a lot of these properties have been bought up over the last couple of years, and they weren't professionally run prior to that. So what's happened is a couple things. One is there was a huge amount of deferred maintenance on a lot of the properties, and the second was Cobb County, where this sits, was one of the last counties in the US to allow evictions again. So a lot of these properties have had a pretty significant amount of non-paying tenants that they weren't allowed to do anything with. So a lot of tenants were taking advantage of that. That's been lifted. That was lifted in January. However, a lot of the properties still have 25, 30% of tenants under eviction that they haven't been able to evict because the sheriff's office only has capacity to do 5 units per month per property. So some of these larger properties that had 50 tenants basically have to wait 10 months, and that's assuming no other evictions come up. So Azure was no different. On the first side of deferred maintenance, this property, and one of the reasons why we like it so much is it's had a huge amount of money put into it, about $6 million, which is primarily on exteriors. So in many ways, it's kind of a new property. The exterior siding is 100% brand new. The windows are brand new. The roofs are new. The balcony railings, the clubhouse. So there's been some really significant capital put in to the infrastructure of the property. And that was 2 owners ago. The current owner, when they inherited the property, since all this work was done and the property was essentially vacated from the previous owner, they inherited a property that had less than 50% economic occupancy. So what they've done is they put in leasing standards and really cleaned up the rent roll over the last year and taken it to about 85% occupancy. That said, they still have a lot of evictions. So we are, and this is kind of an ongoing process. So we expect that we're going to get the property back with about 40 vacant units. I think we've modeled 53 just to be conservative. But we expect to have about 40 vacant units. And but that gives us an opportunity as well to get in and renovate those units as soon as possible, because a lot of them are in classic condition that is really subpar. So we'll be able to really transform a lot of these interiors fast. So with that in mind, it enabled us to kind of get in and get out a lot faster than we would typically be able to do. So this is realistically kind of maybe a 2-year hold. We've underwritten 3 to be safe, but we should be able to get through this a lot quicker. The one other thing I'd mention is while we've underwritten 53 vacancies, one thing to note is that for every eviction above 6, we get a $40,000 price discount from what is currently in the model. We expect that to be anywhere from 400,000 to even north of 800,000 of a discount. And that has a very material effect on the returns in a good way. So we assume the worst case without the benefit of the price reduction. So this should be pretty conservative numbers here that we're looking at. So again, going back to the value add strategy, we expect to do a full renovation on half the units on the interiors. And then we will also paint the exterior. We'll go through the pictures so you can see what we're talking about here. So this is the overview. You can kind of see in the background, the white roofs are basically industrial. So you can see it's literally right behind the property that starts. So the value add that I was going to get into on the exterior is you can see here the landscaping right now. The site had to be regraded. You can't quite tell from this picture, but there is quite a slope to the site. It actually creates a really nice environment. But the problem is the site had to be regraded. That work has been done over the last year, but you're left with essentially dirt for landscaping. So it's aesthetically not really nice at all. You can see here exactly what that looks like. These pictures were taken a month ago, or not even, I don't believe, less than that. So we'll go in and we've allowed a really large budget for landscaping. The other thing that you can kind of see from this picture is if you look at the buildings in the front, for whatever reason, the natural color of the siding was this kind of beige yellow, and they only painted half the property to a really nice gray. But the gray and the yellow beige go terribly together. So while the product itself is brand new with brand new windows, it should look great. They did not complete the painting. So we have allowed in our budget to do that painting as well. This is a pretty, it's they did a good job of making this look better than it does. In person, it doesn't look as nice with the yellow and the gray combination, but it's quite simple that we'll need to paint roughly half the buildings to either the same gray or a color that complements the gray better. But you can see the railings were done, the windows are brand new, the landscaping, the actual foliage is nice, but we need to clean up what's on the ground. This is the pool. It actually looks better now. The pool's just been resurfaced within the last few weeks. The owner had already contracted that. So that's been done. We'll also do enhanced furniture. We're going to put a barbecue in and make this kind of a nice area. It's a pretty large area. So there's a lot of potential here. And then you'll see the clubhouse in the background. This is the sports court. It's more exterior. This is the clubhouse has been renovated. We'll probably add some new furniture in here. They did a pretty good job overall, but we've allowed a little bit of budget to upgrade some of the elements in here. This is, they have renovated some of the units. This is what that looks like. So they did new cabinets, Formica countertops. They did black appliances. We'd be doing stainless steel. We'd probably consider hard surface as well, and maybe a tile backsplash. You'll also notice that they hadn't, on the left, they didn't put in microwaves, which is a pretty in-demand feature. So we'll do that as well. This is a closer look. In the bathroom, same thing. So this is the living room. You can see the new balcony railings. We've been through the area. A couple other points to note that are pretty interesting from upcoming comp perspective. This broader area used to be a little bit more low income, and as the areas really come up with the industrial, rents have gone up significantly. So there's been a lot of concerns about affordable housing. So what the mayor is doing is he's actually implemented a temporary moratorium on any new multifamily with the intent of adding in some sort of affordable requirements for new construction. So what that means is that effectively any new development is become more expensive. The rents are going to have to be higher on market rate units. So this only benefits the area. It also means that there's not going to be any new permits in the short term. So there's not going to be any further upcoming supply at least temporarily. So it's a really great combination for current owners in the area. And then also the average house price has actually come up quite a bit too. So the average mortgage payment all in with taxes and everything is about $3,000 a month. We're underwriting our 3 bedrooms, I believe in the 1700, 1750 range. That's for our largest 3 bedrooms, fully renovated. So it compares quite favorably, just over half the cost of buying. And as we all know, interest rates are only going up, so that's going to go up even more. Just some of the industrial, yes, there is 60 million square feet existing. There's a lot more coming up. Amazon is going in, Microsoft, Stitch Fix is just did almost 1 million square feet. Bang Energy, I believe their site was about 600,000 or 700,000 square feet of industrial coming in. So there's some massive industrial still coming in to the immediate area. So we're looking at about a 70% loan to cost senior loan. We have those terms in place. It's about a 307, I believe it's a 370 basis point spread. It's the operating cash flows, investment cash flow. This is the existing rent roll and kind of renovation status. As I mentioned, these are quite they're larger units overall. You can see, so average in place is about 970. We are assuming a post reno average rent of 1552, which is almost a $600 increase. That probably sounds like a lot, but that's not just due to renovations. That's due to the loss to lease from what's in place to actually what market rent is. And that's been proven out. A perfect example, if you look at the over here on the right at the top where it says 1 bed partial, 750 square feet, their most recent lease for that unit was about $1,325. So the average rent in place is $960, but the newest leases are $1,325. So that market rent has essentially been proven out already. And in addition to that, not only are they in these huge rent increases, but the leasing velocity is high. I believe they did 18 new leases in April, and they're on pace to do 28 this month, which is extremely good for a property of this size. And that doesn't include the renewals, just for clarity. So here's some sample floor plans. They're all laid out pretty well. Here's the other ones. Sales comps. We're pretty much right in the middle. Apologies, this hasn't been updated. The 56 million is incorrect. It's actually 54.7 million, and it's about 204,000 a key. So we sit roughly in the middle of the comp set. A lot of these have traded within the last, well, all of these have traded within the last year. So this is going back to what I was mentioning regarding a lot of institutional owners coming in. There's a property that's for sale not too far away that's at 230 a key right now, or 234, I think, to be exact. It hasn't closed yet, but it is on the market at that rate. So there's quite a wide variety here. The biggest reason for that variety is because some of these properties have a significant deferred maintenance, as I mentioned. And then some of them have rent rolls where they're still 50% economically occupied. So the owner essentially has a negative cash flow for the first year or two, if not longer. Here's a map of those rent comps. And again, another interesting thing to see here is see all those large rectangular white roofs. That's all industrial. So you can see just how much there is right outside the site. So it's really convenient for these kind of mid to upper gray collar workers to live at Azure. They have a very, very easy commute. And then you also see how close it is to Highway 20. It's where the purple circle and star is. That road that intersects it is Highway 20. Rent comps, this is for 1-bedrooms. This is where we're underwriting to. You know, as you can see, we're right in the middle again. Our spec will be better than what most of these have, given that we're doing the newer renos. Some of these were renovated a year or two ago. And then actually 300 Riverside, some of these aren't renovated. So like Forest Glen isn't particularly renovated. 300 Riverside is a very, very light partial renovation. And we're still not too far off those rents. Same with the 2-bedrooms, kind of same story. And then the 3s, again, right in the middle. So this would be a good example of what's possible, basically. So you can see these. This is actually on the market right now, Midwood Riverside. You can see the spec level. The old, they painted the cabinets, but it's the old cabinets, not new doors. It's white appliances. It's mostly carpet throughout. They did LVP in the wet areas, but not in the living areas. It's standard carpet. The architecture you can see on the left isn't great. Yet they are getting $1,465 for these kind of quote unquote upgraded units. And for the same size, I believe, let's see, we're around $1,520. So that is a $60 increase for a fully renovated unit. So it seems to be a pretty good number. This is Sweetwater, a little bit nicer, but you can see their 2-bedrooms are $200 more than what we're projecting. And yes, they have nicer amenities. The interiors, I would argue our kitchens will be nicer, more modern spec than what you can see here, obviously with the black appliances and the kind of cherry cabinets, which are a little dated at this point. So our interiors will be a bit nicer, but yet we're still $200 below what they have in place. So some of the key points on this deal, 4.6% job growth in the area, which is, you know, very strong. Vacancies decreasing still, and with no upcoming supply, that's only going to continue. What's also interesting is we recently learned that when we bifurcated out 4- and 5-star properties, 3-star properties, and 1-star properties, 1- and 2-star rather, the 1- and 2-star are the vast majority of that vacancy. The 3- through 5-star, the vacancy is less than half. So when you see these kind of broader market vacancies, it's actually even better for the properties that are within our comp set. Rents increasing. This is probably a very similar graph to everyone you've seen in our deals in the Southeast. It's pretty much across the board here. Population growth, same thing, continues to increase. Showing the growth of the purchase price, we're pretty much bang on average here for the market. So let's see. And then of course the rent increases. With the moratorium, which was a recent announcement, this graph, if updated, is probably going to look even steeper. But we just don't know how that's going to play out, but it's going to be at least somewhat better because there is a current pause and there will be some additional costs for developers of new construction. Our rent forecast. So we look at rent forecasts from CoStar and from Reis. CoStar's averaging a little over 5% during our hold period, and Reis is a little over 4%. We're at 4.3. The CoStar and Reis numbers were done pre-building moratorium, so those would probably go up higher as well now. But we're kind of right in line with what the market data suggest. We're on the lower side, actually.
Marley, somebody asked about debt. Can you go back? I think you may have skipped the slide with the debt on it. Can you quickly recap the debt?
Yeah, so the debt we're looking
No
at
pun
70%
intended.
loan to cost. Where we go? So 70% loan to cost, and I believe, and I guess we're doing a 390 spread here. I'm not sure the other questions, but
No, it's bridge loan.
It's actually
390
a
over.
it's a 4+1 bridge loan. It's actually 360 over I think it's a 30 pip spread, 71% loan to cost from Ready Cap.
so here's the exit cap chart. We are underwriting a 4.4 exit cap. In the market, it's about 4.6 to 4.7, but that's for fully stabilized deals. We'll be selling this property with half the units unrenovated. So there's a big upside for whoever is buying the property. We usually see about a 50 basis point compression from that. So that would be about a 4.1 to 4.3 exit cap. And we're at 4.4. So we feel that's pretty in line with where the market sits. The population growth numbers, within a 2-mile radius, you're talking about 82,000 average household income, which is very good considering the rents. Important number here is that within 3 miles of the property, 50% of households earn more than 61,000, which I believe it's actually another way to look at it is within 3 miles, more than 60% of the residents earn more than 52,000. That would mean that 60+% of the residents qualify for the average rent at our property, which is a really good number. Our average forecasted renovated rent, to be more specific. Just again, huge population growth. And here's a summary of a lot of what we just talked about. We're just under market for average price per unit within the comp set. Our rents, the in-place rents versus market versus post-renovated have huge deltas. The vacancy rate at Azure is currently high, but we're getting paid for that if it stays like that by the time that we close. It was a really unique structure we worked out with the seller. We're very happy with it. It frankly benefits us quite significantly. We're almost hoping for more vacancy in this case, given how much we get paid per unit. The average in-place rent is $1,000, but we get $40,000 for every unit, above 6, above a count of 6. So that's really great for us. And then the upcoming supply, it's a little unsure right now, but there's been on average 400, which for this size of market is quite small. And that's pretty much it.
What questions can we answer for you?
Yes, we are doing a rate cap on the loan. We capped it. We're doing it at 3%, and that cost is factored into the underwriting already.
It's a 2-year term.
Yep.
There are no other.
Yeah, the units currently don't have washers and dryers, so that's part of the value add.
Well, there are 2 lines of questions here. Sorry, I've got questions coming in through the chat and questions coming in through the Q&A. So are there any other, somebody asked, are there any other parties in the capital stack? Will this also be in your fund? The answers are no and yes. It's a straight syndication. Mitch and I might exchange into it. We have an exchange, so we might have significant skin in the game. and our fund will participate as well. Does the site have a laundry mate? There's a laundry room, but we're planning on putting washer and dryer in every unit. That's low hanging fruit. That's very easy value add. It's the best, most in demand in unit amenity, and it's just a no brainer. Distributions when yield. The distributions will probably be renovating for the first 18 to 20 months. Then we'll refinance it, make a distribution on the capital event, and at that point we'll make distributions on operating cash flow, which will probably be, you know, end of year 2, like 5 to 6.5% range, and then grow from there. How's the waterfall split with the fund versus individual investors to this deal? There's no difference. Well, the fund is the fund. Whatever an individual's fund economics are is what they are. And in the deal, it's 75-25 after an 8% preferred return with a catch up on the preferred return. Let's go to the Q&A box. Can you please go into more detail regarding the debt? It is a 4-year bridge loan. It's a 4+1 from ReadyCap. After the spread is what, 365?
It's 360 over a 25 bips floor.
360 over.
Or it
So
might be
it's
30 bips.
the floor doesn't even matter anymore. So 360, 3.6% over the SOFR. 72% of cost, Adri? 71.5?
71%.
71% of cost.
I answered this question in the Q&A. It's under the answered section.
Yeah, there are two boxes. Some people are asking in the Q&A section. Some people are asking in the chat.
Yeah.
How would you compare these properties to the recent ones in Denver and Miami? Good question. It's very similar. Straightforward value add play, suburban, they're all 1970s, suburban garden style, multifamily, very similar strategy. Go in. This one's a little bit of a heavier lift, but we're getting paid for it. And you go in, renovate the interiors of the units. On this one specifically, the exteriors have most of the common area and exterior have been done. So this is just an in-unit play. And what's great here is it's already got washer dryer hookups, and we just go in and put the machines in.
Can you expand a little more on the, so on the 40K
Yeah, go ahead, Murray.
price reduction? Yep. So when we bought this, we said we'd only buy this with essentially a clean rent roll. And that was always kind of part of the deal. So the agreement that we made, but when we initially were looking at this, there were a lot of evictions. The seller was extremely confident that they would have that cleaned up by the time that we closed. So we just said, fine, put your money where your mouth is. So they did. And the way that we've agreed that is for any unit that is delinquent on payment of 30 days or more, we give an allowance of 6 because delinquency at 30 days, like, you know, for a property like this, that's not totally unusual. 6 is about 2%, which is pretty standard. And so for anything more than 6, they owe us $40,000 per unit. So it's just that simple. So for any tenant that is 30 days or more delinquent, they owe us $40,000 per unit. And right now we get updates on this weekly. We're expected to close in about a month. We expect we're forecasting that's going to be somewhere around 15, maybe 20 units. So you're talking about $600,000 to $800,000 in price reduction. But for the sake of conservativeness, we assumed that vacancy. We assumed a higher number of vacancy at 53 units, which is 20% of the property, just to be safe. So the model includes 53 units as vacant / non-paying, but we have the purchase price at the higher price. So we didn't deduct the 40,000 per unit from the purchase price currently. And that actually has a material effect on the returns in a very good way. But again, just for the sake of being conservative, that's the way that we did it. Why was the grading done? So this site as I mentioned, it's a bit on a hill. Let me see if I can go to, let me see if there's a picture that shows it better. So this site does have a decent slope to it. You can kind of see here off to the right. It's not all this slope, but there is decent areas of slope. So over the years, the water runs off, creates a different grade to the property. Actually, this is a perfect example because in one area, a lot of the water is draining into the pool and into the pool area every time there was a heavy rain. So the current owner spent a pretty decent amount of money regrading the site so that now there's some additional drainage. The slope has been changed. So all that's been taken care of. And you can kind of see, if you look to where the pool is, you can see that retaining wall that was put in. That actually was done partially for drainage as well. So now it's blocked off from draining into the pool area. It actually drains out to a kind of a wash basin that's to the right of the property. If the interest you're paying hits the full 6.6 rate, how is that going to affect the projections? Well, if the interest rates go up that high, that's going to be due most likely to a lot of inflation, and rents will rise probably more than enough to counteract that interest rate. So one wouldn't happen without the other. So it counterbalances. Being a gray collar community, how badly would a recession affect investor IRR? Good question. I think that highly depends on what those gray collar jobs are. In the logistics world, I would say the effect is going to be very minor. Logistics is a massively growing sector of the economy. And in this particular part of the world, it's growing even more than the average logistics. One of the big benefactors of we're buying a deal in Savannah. The port of Savannah is one of the largest ports in the country. It's actually doubling in size over the next year or two. Once those goods hit the water, they go to a couple different places. This is one of the main places that they go to because it's right up the highway. So this area there's a knock-on effect where this area is expanding as a result, and that's evidenced by the slide where we showed where Amazon is adding a bunch of square feet. Stitch Fix is adding nearly 1 million square feet. Bang Energy is doing the same thing. This is becoming it's 60 million square feet already, and there's millions. I forget the exact number, but it's in the 10 million range of square footage that's being added over the next couple of years. So it's still growing, but gray collar itself, maybe some other types of gray collar jobs, that wouldn't be the case. But for logistics, which is the primary driver of this area, I don't see that being an issue. What's the break-even occupancy? Good question. I don't have that answer, to be honest with you. Well, we can figure that out.
There's a question in the chat on the refi. Will you return any money to equity holders? We can't give you an exact projection, but typically we can return usually like 20 to 50% of your initial equity commitment. There likely won't be much distributions prior to the refi occurring. Can you get us to a 7% distribution? The cash on cash probably won't hit 7%. And then it says, would you project cash on cash return at sale? This deal projects, I believe it was a 1.17 or 1.8 multiple. I'm sorry, a 1.16 multiple. So basically, if you put in 100 grand and we hit our projections on the exit, you'll receive 160 grand. So 100 of your initial commitment and then 60,000 in profit. And then just on a housekeeping matter, in the very top of the chat, I posted the link to basically our lead capture form for this deal. We have the PPM finalized now. So basically, within 15 minutes of the end of the webinar, we will begin accepting subscriptions. If you've already filled out that form, you'll be emailed notifying you of this. And then if you fill it out now, you'll receive an email giving you access to the full PPM where you can make a subscription. And we're currently set to close June 30th. So we typically call capital 10 days prior. So we'll ask that funds, you execute your documents and have funds in by June 20th. I believe we've answered all the questions. If we missed any, then feel free to reach out to either myself, Marley, or Max, or Adri. And yeah, we look forward to hopefully having you on board and a successful investment. Do you accept Bitcoin? We do not accept Bitcoin. Max, don't mute.
Only Ethereum and Dogecoin. Thanks everyone for attending. Really appreciate your time.
Thanks, guys.
All right, bye-bye.